Last year, my friend Jake put $5,000 into a fractional share of a Banksy artwork instead of an index fund. While my safe investment crawled up 8%, his art investment jumped 26% in the same period. I couldn't believe what I was seeing on his portfolio app. This got me questioning everything I knew about investing. Today, I'm sharing 5 alternative investment vehicles that are outperforming traditional markets, including fine art that's up 433% since 2004, luxury watches appreciating 20% annually, and how everyday investors are getting into these previously exclusive markets with as little as $10. Why traditional investing isn't cutting it anymore. Have you noticed your safe investments barely keeping up with inflation lately? That's not just a feeling. It's a financial reality hitting millions of investors where it hurts most, their future security. That 401k or index fund portfolio that was supposed to be your ticket to financial freedom. It might be moving a lot slower than you think. Let's get real about traditional investing for a minute. Those stock market returns your parents or financial advisor promised you, typically around 9.6% annually since 1995, sound pretty good on paper. But that number is hiding some serious problems that are eating away at your wealth right under your nose. When you factor in inflation, which has averaged about 2.3% annually over the long term, but recently spiked to 7 to 9% in 2022, your real returns start looking a lot less impressive. And that's before we even talk about investment fees and taxes. The average expense ratio on mutual funds can silently steal 0.5% to 1.5% of your returns each year. Then there's capital gains tax, which can take another 15 to 20% bite out of whatever growth you manage to achieve. Let's break this down with some brutal math. If you're earning that average 9.6% in the market, subtract 2.5% for inflation, being conservative, 1% for fees, and another 2% for taxes. Suddenly your actual purchasing power is growing at just about 4% per year. That's less than half of what most investors think they're getting. Look at the last 5 years as a perfect example. If you invested $10,000 in an S&P 500 index fund in 2018, you might have around $15,000 today before inflation. But when adjusted for inflation, your purchasing power only increased to about $13,000 in real terms. That's just not cutting it for many people trying to build wealth. This reality has left a whole generation of young investors frustrated and searching for alternatives. Take Emma, a 29-year-old software developer from Seattle who followed all the right financial advice. She maxed out her 401k contributions for 6 years straight, only to watch her retirement account crawl upward while housing prices in her area doubled. "I did everything they told me to do," she says, "and I'm still nowhere close to affording a home." Or consider Marcus, a 35-year-old teacher who's been investing 15% of his income for a decade. "I've got about $120,000 saved, but that won't generate enough passive income for me to retire until I'm almost 70. Something's broken with this system. The psychological impact of watching your money grow too slowly can't be understated. Financial anxiety is at record levels, with 73% of millennials and Gen Z reporting stress about their financial future. There's a growing sense that traditional investment advice, the invest and wait approach, isn't aligned with the economic realities facing younger generations. Why don't financial advisors suggest more aggressive alternatives? It's not always because these alternatives don't work. Many financial professionals operate under strict regulatory guidelines and fiduciary responsibilities that push them toward conservative recommendations. They're often limited to suggesting only certain types of registered securities, leaving a whole world of alternative investments off the table. The typical advisor portfolio recommendation, usually some variation of a 60-40 stock/bond split, has been industry standard for decades. But this approach was developed in a completely different economic era, when bonds actually delivered meaningful returns and housing was affordable. Today's financial landscape requires fresh thinking. Here's where things get interesting. While traditional investments have been delivering underwhelming results, a quiet revolution has been happening in alternative investment markets. Assets that were once available only to the ultra-wealthy are now becoming accessible to everyday investors through new platforms and technologies. Look at the numbers. Contemporary art has delivered average annual returns of 12.6% between 1995 and 2022, handily beating the S&P 500's 9%. Private equity investments have averaged 13.5% annually over the same period. Certain collectibles like rare watches have appreciated 20% per year since 2018. These aren't just small blips, they represent consistent outperformance. Over decades, what makes these alternatives even more attractive is that many have low correlation to stock markets. When stocks tank during recessions or corrections, many alternative assets either hold their value or drop much less dramatically. Some even increase in value during market downturns as investors seek safe havens. The even better news? You no longer need to be a millionaire to access these investment classes. New investment platforms have democratized access to everything from blue-chip artwork to commercial real estate. Minimum investments that once started at $100,000 or even $1 million are now as low as $20 in some cases. Think about it this way. The ultra-wealthy have always diversified beyond stocks and bonds. The average high-net-worth individual keeps about 30% of their portfolio in alternative investments. Meanwhile, the average retail investor has less than 5% in alternatives. That's not just a gap. It's a chasm in investment strategy that has real consequences for wealth building. The data is clear. From 2000 to 2020, a traditional portfolio of 60% stocks and 40% bonds returned about 5.4% annually after inflation. During that same period, the endowments of elite universities like Yale and Harvard, which heavily utilize alternative investments, returned closer to 8.2% annually after inflation. That difference might seem small, but compounded over decades, it represents millions in additional wealth. What's particularly interesting is how these alternative investments have performed during market downturns. During the 2008 financial crisis, when the S&P 500 plummeted nearly 40%, certain alternative asset classes like gold increased in value by over 5%. During the COVID-19 market crash of March 2020, when stocks dropped 30% in a month, blue-chip art declined by only 4 to 6% before quickly recovering. Financial professionals who exclusively recommend traditional investments are leaving serious money on the table, your money. The good news is that you don't need their permission to explore alternatives. New platforms have made these investments more accessible than ever, and the information asymmetry that once benefited only the wealthy is disappearing. Fine art, the blue-chip alternative that's crushing the market. The wealthy have always known something the average investor hasn't. Fine art isn't just pretty to look at. It's a financial powerhouse that's outperformed the stock market by 175% over the last 2 decades. And that exclusive club guarding the art world's wealth-building secrets? The velvet rope just came down. Think about it. While most of us have been obsessively checking our 401k, and stock portfolios, the ultra-wealthy have been quietly amassing fortunes through brushstrokes and canvas. But here's the thing. Until recently, you needed millions just to get your foot in the door of this exclusive investment club. For generations, fine art has been the playground of the ultra-wealthy, billionaires dropping 8 figures at Christie's and Sotheby's auctions while sipping champagne. The barrier to entry wasn't just high. It was practically insurmountable for everyday investors. You couldn't exactly buy a quarter share of a Picasso or invest $500 in a Monet. It was all or nothing, and all meant millions. This exclusivity created a perfect storm for the wealthy, an investment class that delivered incredible returns but remained inaccessible to the masses. But why has art been such a powerful wealth-building tool? When the stock market takes a nosedive, art often holds steady or even appreciates. This lack of correlation with traditional markets is what makes fine art such a powerful diversification tool. During economic downturns, when your stocks are taking a beating, your art investments can provide that much-needed stability. It's like having an insurance policy against market volatility that actually pays dividends. The numbers don't lie. Since 2004, the Art Price 100 Index, think of it as the S&P 500 of the art world, has increased by an astonishing 433%. During that same period, the S&P 500 grew by only 258%. That's not just beating the market, that's absolutely crushing it. Let me share a real-life example that might make you rethink everything you thought you knew about investing. Helen Frankenthaler's painting Giant Step, was purchased for just $153,100. 17 years later, it sold for $2.4 million. That's a return that would make even the most successful stock picker jealous. And this isn't some one-off miracle. These kinds of returns happen regularly in the art world. But here's the game changer. Platforms like Masterworks have completely revolutionized how we can invest in art. They've introduced a fractional ownership model that lets regular people like you and me invest in multi-million-dollar artworks without needing a trust fund. Here's how it works. Masterworks purchases blue-chip artworks, pieces by established artists with proven track records of appreciation. They then securitize these paintings, allowing investors to buy shares for as little as $10. Yes, you heard that right. $10 can get you partial ownership in a masterpiece that might otherwise cost millions. The platform handles all the headaches that would normally come with art investing: the authentication, storage, insurance, and eventually, the selling process. When the artwork sells, typically after 3 to 10 years, investors receive their proportional share of the profits. Of course, there are fees involved. Masterworks charges a 1% annual fee, which breaks down to 0.85% for asset management and 0.15% for advisory services. That's competitive with many mutual funds and ETFs, especially considering the specialized nature of art investing. The $65 billion art market is no longer reserved for billionaires and museums. In 2023 alone, over 1 million artworks sold at auction, showing just how robust this market is even during uncertain economic times. And the best part, this market has historically shown lower volatility than traditional stock indices. Think about what this means for your portfolio. While traditional investments are important, they're just one piece of the puzzle. By allocating a portion of your investments to fine art, you're not just diversifying, you're tapping into an asset class that has consistently outperformed the stock market while reducing your overall portfolio risk. The art market's resilience during economic downturns is particularly valuable in today's unpredictable economic climate. When stocks tumble, having investments that hold their value can mean the difference between weathering the storm and watching your net worth evaporate. What makes this opportunity even more compelling is that we're still in the early stages of this democratization. The information asymmetry that once benefited only the wealthy is disappearing as platforms like Masterworks provide data, analytics, and access previously unavailable to everyday investors. Of course, like any investment, art comes with its own risks. Not every painting will appreciate, like those headline-grabbing examples. The market can be illiquid, meaning you can't just sell your shares whenever you want. You're generally locked in until Masterworks decides to sell the entire artwork. But for a portion of your long-term investment portfolio, this illiquidity can actually be a benefit, preventing you from making emotional decisions during market turbulence. What's particularly exciting is that this investment opportunity isn't just about potential returns. There's something uniquely satisfying about owning a piece of cultural history, even if it's just a fraction. It connects your financial growth to human creativity and expression in a way that buying shares of a corporation simply can't match. Sneaker investing, from streetwear to serious returns. From masterpieces to footwear masterpieces. Did you know the sneaker market you might be dismissing as just shoes is projected to explode from $10.6 billion today to over $51 billion by 2032? Those aren't just fashion statements on your feet. They're potentially better growth vehicles than most stocks in your portfolio. While art collectors hang priceless paintings on their walls, sneakerheads are building investment portfolios right in their closets. The difference? You don't need millions to get started with sneakers. That pair of limited edition Nikes you've been eyeing might actually be your ticket to impressive returns. Let's be real, most people see sneakers as functional fashion items that lose value the moment you wear them. But this perception couldn't be further from the truth when it comes to certain sneakers. The right pairs aren't depreciating assets. They're legitimate investment vehicles that can appreciate dramatically over time. Take the NYC Pigeon Nike Dunks, for example. These unassuming gray and pink shoes originally retailed for just $200 when released. Today, they command prices up to $38,000 on the resale market. That's a mind-blowing 19,000% return on investment. Imagine turning a couple $100 into enough cash to buy a luxury car, all from a single pair of sneakers. What's fascinating about sneaker investing is how it's driven by cultural factors rather than traditional market metrics. Unlike stocks, where quarterly earnings reports determine value, sneakers gain worth through completely different channels. Limited production runs, high-profile collaborations, cultural relevance, and celebrity endorsements. When Travis Scott partners with Nike or Kanye designs for Adidas, they're not just creating footwear, they're minting potential investment assets. These collaborations tap into powerful cultural currents that traditional investments simply can't access. A sneaker's value doesn't just come from materials or craftsmanship, but from its place in our collective consciousness. The sneaker investment game changed forever with the emergence of dedicated marketplaces like StockX and GOAT. These platforms brought much-needed structure to what was once a chaotic ecosystem dominated by eBay listings and risky in-person meetups. They've essentially created a stock market for sneakers, complete with price histories, market data, and most importantly, authentication services. This last point is crucial. One of the biggest risks in sneaker investing has always been counterfeit products. How do you know if you're buying the real deal? StockX and GOAT have addressed this by implementing rigorous authentication processes. When you sell on these platforms, you don't ship directly to the buyer. Instead, you send your sneakers to the platform's authentication center, where experts verify their legitimacy before forwarding them to the buyer. The numbers speak for themselves. StockX rejected over 325,000 products last year alone for failing to meet verification standards. This built-in protection system has given investors the confidence to enter the market, knowing they're getting authentic products when they buy and that their authentic products will be properly verified when they sell. That said, the sneaker market isn't without its challenges. Recent data suggests a potential cooldown, with eBay's sneaker sales dropping by over 30% and average prices decreasing by 16% in the past year. This volatility is something every prospective sneaker investor needs to understand. Like any market, sneakers experience boom and bust cycles, and getting in at the wrong time could leave you stuck with inventory that's temporarily lost value. So how do you actually make money in this space? Successful sneaker investors follow a few key strategies. First, they monitor secondary market activity to gauge long-term potential. If a sneaker immediately sells out and commands high resale prices, that's a good indicator of future performance. Interestingly, the smartest investors sometimes wait for the initial hype to die down before making their move. When a hot sneaker first drops, prices often spike dramatically due to immediate demand, then settle a bit in the following months. This dip can be the perfect entry point for investors looking for long-term gains rather than quick flips. Storage is another critical consideration. Unlike digital assets, physical sneakers require proper care to maintain their value. Exposure to sunlight, moisture, or improper storage can drastically reduce a sneaker's worth. Serious collectors keep their investment-grade sneakers in temperature-controlled environments, often in their original boxes with all packaging intact. Authentication remains a perpetual challenge, even with platforms like StockX and GOAT providing verification services. The counterfeit market has become increasingly sophisticated, with fake sneakers sometimes being nearly indistinguishable from the real thing to the untrained eye. This is why many investors stick to purchasing directly from retail sources or through authenticated resale platforms rather than private sales. Despite these challenges, the upside potential is undeniable. Certain limited edition sneakers have delivered returns exceeding 6,000% in just a few years. That's a performance that would make even the most successful hedge fund managers jealous. The beauty of sneaker investing is that these returns aren't restricted to financial elites. Anyone with knowledge and a modest starting budget can participate. The market has democratized access to potentially lucrative returns in a way that traditional finance simply hasn't. You don't need a fancy degree or connections to Wall Street. What you do need is cultural awareness, timing, and an understanding of what drives value in this unique market. For newcomers, it's wise to start small and diversify. Rather than pouring your life savings into a single pair of hyped sneakers, consider building a varied portfolio across different brands, styles, and price points. This strategy helps mitigate risk while exposing you to multiple potential winners. Education is also key. Before jumping in, spend time learning about the market. Follow sneaker news sites, join online communities, and study price histories on platforms like StockX. Understanding the difference between truly investment-grade sneakers and ordinary releases will save you from costly mistakes. The sneaker market's continued growth relies on its cultural relevance. As long as sneakers remain central to fashion, music, sports, and broader cultural movements, the investment thesis holds strong. The projected growth to $51.2 billion by 2032 isn't just based on current trends, but on the deepening relationship between sneakers and global culture. What makes sneaker investing particularly appealing is its tangibility. Unlike stocks or bonds, you can see, touch, and even wear your investments, though serious investors typically don't. There's something satisfying about holding an asset. Luxury watches. Time really is money. Speaking of tangible investments, that watch on your wrist might be worth more than just telling time. While most people view luxury watches as expensive status symbols that lose value the moment you walk out of the store, savvy investors are quietly making returns that would make Wall Street veterans do a double take. Did you know a single Patek Philippe watch purchased between 2017 and 2022 could have delivered a mind-blowing 207% return? That's triple what the S&P 500 managed during the same time frame. The luxury watch market isn't just ticking along, it's exploding, reaching nearly $50 billion in 2024. This isn't your average collector's hobby anymore. We're talking serious investment potential that combines craftsmanship, scarcity, and centuries-old prestige. What makes these timepieces so special? Unlike mass-produced fashion accessories, luxury watches from prestigious brands are crafted with painstaking attention to detail, often taking months to assemble by hand. Many models are deliberately produced in limited quantities, creating natural scarcity that drives up value over time. When we talk about watch investing, three names stand tall above the rest: Rolex, Patek Philippe, and Audemars Piguet, the big three of horological investments. These aren't just brands. They're institutions with centuries of heritage backing their reputation. Audemars Piguet, for instance, is renowned for its intricate designs and exclusivity. Their Royal Oak model has become particularly sought after in investment circles, with prices climbing steadily year after year. The combination of distinctive octagonal bezels, integrated bracelets, and mechanical mastery makes them instantly recognizable to those in the know. What's fascinating about luxury watches is their resilience during economic downturns. When stock markets tumble, these timepieces often hold their value or recover faster than traditional investments. During major market corrections, while your stock portfolio might be bleeding red, certain watch models continue to tick along nicely, sometimes even appreciating in value. But what drives this consistent appreciation? Several factors come into play. Brand heritage matters enormously. Watches from established manufacturers with centuries of history typically hold value better than newcomers. Limited production runs create natural scarcity, while special materials like precious metals and rare complications add intrinsic value that transcends trends. Then there's condition. A well-maintained watch with original documentation can command significant premiums. The patina that develops on vintage models often adds character and value rather than diminishing it, something few other investments can claim. The great news for potential investors is that you don't need a trust fund to get started. While headline-grabbing auction prices might suggest otherwise, entry-level luxury watches with growth potential can start around $1,000. Many collectors find sweet spots in models priced between $10,000 and $15,000, which offer excellent value propositions for new investors looking to dip their toes into horological waters. Vintage models often provide better value than brand new pieces. The initial depreciation has already occurred, and many vintage watches have already demonstrated their ability to appreciate over time. Plus, there's something undeniably cool about wearing a piece of history on your wrist that also happens to be increasing in value. Of course, watch investing isn't without practical considerations. Authentication is absolutely critical in this market. With sophisticated counterfeits becoming increasingly common, buying from reputable sellers and verifying authenticity through established platforms isn't just recommended, it's essential. Then there are the maintenance costs to consider. Unlike stocks that sit in your brokerage account maintenance-free, luxury watches require regular servicing to maintain their value and functionality. Servicing a Rolex can cost between $500 to $1,000 every 5 to 10 years, depending on the complexity of the model. These maintenance expenses should be factored into any potential return calculations. Insurance costs add another layer of expense. Protecting your investment properly means getting specialized coverage, which adds to the overall cost of ownership and impacts your net returns. But consider it this way. Would you leave a $20,000 investment completely unprotected? If you're serious about watch investing, experts recommend focusing on brands with proven track records of appreciation. Beyond the big three, Tudor, Rolex's sister brand, offers excellent value, while independent manufacturers like FB Journe have shown impressive growth in recent years. The luxury watch market also offers something many traditional investments don't: the ability to actually enjoy your asset while it appreciates. You can wear your investment to important meetings, special occasions, or just because you want to glance down at your wrist and smile. Try doing that with a stock certificate or bond. What's particularly interesting about watch investing is how the market has evolved. The surge in interest in pre-owned watches has created a vibrant secondary market where values have climbed significantly. Many collectors are now viewing these timepieces not just as luxuries, but as alternative assets for portfolio diversification and inflation protection. Like any investment, timing matters. The watch market experiences trends and fluctuations, though typically less dramatic than stock markets. Research specific models thoroughly before purchasing, and consider consulting watch investment platforms that track historical price data and market movements. For beginners, starting with established models with proven track records makes sense. The Rolex Submariner, Omega Speedmaster, and Cartier Santos have demonstrated consistent appreciation while remaining relatively accessible compared to six-figure timepieces. Authentication processes have become increasingly sophisticated as counterfeit operations have grown more advanced. Modern luxury watches often include micro-etched serial numbers, holographic stickers, and other security features that help verify their authenticity. When purchasing, always ask for original boxes, papers, and service history. They significantly impact resale value. The community aspect of watch collecting shouldn't be overlooked either. Connect with other collectors through forums, social media groups, and watch events. These connections not only enhance your enjoyment, but can lead to valuable insights and potential private sales opportunities with fellow enthusiasts. Fractional real estate. Property investing without the headaches. Looking at your watch collection is one thing, but what about the dream of property ownership that's been moving further out of reach for millions? Real estate has long been the backbone of wealth creation in America. But with median home prices soaring past $400,000 in down payments, often exceeding $80,000, many would-be investors have been left on the sidelines. What if there was a way to bypass these massive barriers and still get your piece of the property pie? That's exactly what fractional real estate investing offers. And you don't need a six-figure salary or perfect credit score to get started. We're talking about accessing the same asset class that's created more millionaires than any other investment, but without the headaches of midnight maintenance calls or tenant drama. Traditional real estate investing is like trying to eat an entire pizza by yourself. Expensive, overwhelming, and potentially painful. You need to save for years for a down payment, qualify for a mortgage, handle maintenance issues, find reliable tenants, and deal with all the paperwork and legal requirements. One bad tenant or major repair can wipe out years of profits. No wonder so many people look at real estate investing and think, maybe someday, but definitely not now. But fractional investing flips this model completely. Instead of buying the whole pizza, you're buying just the slices you can afford. Platforms like Fundrise, Concrete, and CrowdStreet are revolutionizing property investment by allowing multiple investors to own shares in real estate projects, splitting both the costs and the income. Here's how it works. These platforms pool money from thousands of investors to purchase properties. Everything from apartment complexes and commercial buildings to single-family homes and development projects. As an investor, you own a percentage of these properties proportional to your investment. When the properties generate rental income or appreciate in value, you receive your share of the profits. The most mind-blowing part? You can start with just $10 on platforms like Fundrise. Concrete takes accessibility even further with a $1 minimum investment, focusing primarily on first-lien mortgages on commercial real estate. For those with a bit more capital, CrowdStreet offers opportunities to invest in specific commercial real estate projects. though their minimum investment typically starts around $25,000. But don't let the low entry points fool you. The returns can be substantial. Fundrise reported an average return of 22.99% across all its funds in 2021. Now, I should mention that 2023 was rougher, with an average return of -7.45%, which perfectly illustrates that real estate isn't immune to market downturns. Still, the historical average of 8.6% annual returns remains impressive, especially considering the minimal effort required from investors. What makes fractional real estate particularly interesting is the variety of options available. You're not limited to just one type of property. You can diversify across residential properties, apartment buildings, single-family home portfolios, and multifamily units that generate steady rental income, commercial real estate, office buildings, retail spaces, and industrial properties with typically longer lease terms, REITs, real estate investment trusts, companies that own and operate income-producing real estate across various sectors, development projects, new construction opportunities that offer potential for higher returns but come with increased risk. This diversification is crucial because different property types perform differently depending on economic conditions. During the pandemic, for instance, residential properties and industrial warehouses outperformed office spaces and retail. Having exposure to multiple property types helps smooth out those bumps. One of the biggest advantages of fractional real estate investing is that you still get many of the tax benefits associated with traditional property ownership. This includes potential depreciation deductions that can offset your taxable income. Some platforms even allow investors to participate in 1031 exchanges, which let you defer capital gains taxes when selling one investment property and reinvesting in another. Another major benefit is professional management. Unlike being a landlord, you won't be fixing toilets at 2 a.m. or chasing down late rent payments. Professional property managers handle all the day-to-day operations, from maintenance to tenant relations. This dramatically reduces the stress and time commitment typically associated with real estate investing. Of course, fractional real estate isn't without drawbacks. Liquidity is perhaps the biggest concern. Unlike stocks that you can sell with a few clicks, real estate investments, even fractional ones, aren't designed for quick cash access. While platforms like Fundrise offer redemption programs, they often come with restrictions on when and how much you can redeem, especially during market downturns. Fee structures are another consideration. Fundrise, for example, charges a total annual fee of 1%, which includes a 0.85% asset management fee and a 0.15% advisory fee. While these fees are actually quite reasonable compared to traditional real estate investments, where property managers typically charge 8 to 12% of rental income, they will still impact your bottom line. It's also worth noting that you give up some control with fractional investing. You're not picking the specific properties or making decisions about improvements, tenant selection, or when to sell. You're essentially trusting the platform's management team to make those decisions on your behalf. Despite these limitations, fractional real estate investing represents a genuine democratization of an asset class that was previously reserved for those with significant capital. It's particularly valuable for new investors looking to diversify beyond stocks and bonds without committing large sums or taking on the responsibilities of direct property ownership. For those concerned about volatility, real estate has historically shown lower price fluctuations compared to stocks. While property values do go up and down, they typically don't experience the dramatic daily swings seen in the stock market. This relative stability can help new investors sleep better at night, especially during turbulent economic times. The accessibility factor cannot be overstated. With traditional real estate, saving for a down payment can take years or even decades in high-cost areas. Fractional investing removes this barrier entirely. You can literally start building your real estate portfolio while waiting for your coffee order. That's how easy these platforms have made it. Most platforms also make it simple to automate your investments. You can set up recurring transfers of as little as $10 per month, gradually building your real estate portfolio over time without having to think about it. This set-it-and-forget-it approach helps overcome the psychological barriers that often prevent people from investing consistently. Tech startups, getting in on the ground floor. Those automatic $10 transfers into real estate investments might be impressive, But what if I told you there's an investment opportunity where just one successful pick could absolutely transform your financial future? While most people think of venture capital as a playground exclusively for Silicon Valley millionaires and billionaires, the investment landscape has dramatically shifted in recent years. For decades, startup investing was indeed the exclusive domain of the ultra-wealthy and well-connected. Venture capital firms and angel investors typically required minimum investments of hundreds of thousands, if not millions, of dollars to participate in funding rounds for promising startups. This high barrier to entry effectively locked out everyday investors from what has historically been one of the most lucrative investment categories in existence. But here's what's changed. The Jobs Act of 2012 and subsequent regulatory updates have completely revolutionized access to startup investing. Today, platforms like AngelList, Republic, and WeFunder have democratized the entire process, allowing regular people to invest in early-stage companies with surprisingly small amounts of money. This change represents one of the biggest shifts in investment access in modern history. What makes startup investing so potentially lucrative? It all comes down to timing and growth potential. When you invest in a publicly traded company, you're buying in after most of the exponential growth has already happened. With startups, you're getting in on the ground floor, before the massive value creation occurs. The stages of startup investing follow a predictable pattern that's worth understanding. It starts with pre-seed funding, where founders are often just working with an idea or early prototype. At this stage, valuations typically range around $10 million in 2024, up 20% from just a year ago. Seed stage companies have usually demonstrated some early traction, with median valuations reaching $20 million in 2024, an 18% increase year over year. These dramatic increases in early valuations reflect growing investor appetites, particularly in hot sectors like artificial intelligence. After seed funding comes Series A, B, and C rounds, where companies scale operations, expand market share, and prepare for potential exits through acquisitions or IPOs. At each stage, the valuation typically increases, but so does the entry price for investors. That's why getting in early can be so advantageous. Now, here's the statistic that makes startup investing truly fascinating. According to AngelList data, approximately 2.5% of venture-backed seed-stage startups may achieve unicorn status, meaning they reach valuations of over $1 billion. That translates to a 1 in 40 chance that an early-stage investment could deliver returns that dwarf anything possible in public markets. Just imagine hitting that one investment that turns $1,000 into millions. The rise of unicorns has accelerated dramatically in recent years. In just the first half of 2024, 245 companies achieved valuations exceeding $1 billion. That's more than the total for all of 2019 and 2020 combined. This isn't just a blip, it's a fundamental shift in how quickly companies can scale to massive valuations. But let's be realistic, startup investing comes with extreme risk. The uncomfortable truth is that most startups fail, completely. Your investment doesn't just drop in value, it can go to zero. Unlike publicly traded stocks that might recover from downturns, failed startups simply cease to exist, taking your investment with them. This high-risk profile is precisely why startup investing requires a portfolio approach. Smart investors don't put all their money into a single startup. Instead, they spread smaller investments across multiple companies, knowing that one or two successful picks can more than compensate for numerous failures. The beauty of today's startup investing platforms is that they make this portfolio approach accessible. On platforms like Republic, you can invest with minimums as low as $100 per startup. This means with $1,000, you could theoretically build a portfolio of 10 different early-stage companies, dramatically increasing your chances of finding that one winner that delivers those life-changing returns. These platforms also handle much of the complex legal work that previously made early-stage investing so cumbersome. They provide standardized deal documents, handle compliance requirements, and offer due diligence materials to help investors make informed decisions. What's particularly interesting for investors looking beyond the obvious is that startups in emerging tech hubs are actually outperforming Silicon Valley companies. The aggregate internal rate of return, IRR, for startups in these rising tech centers is 19.4% per year, compared to Silicon Valley's 17.5%. This surprising data point suggests that the best opportunities might not be where conventional wisdom would have you look. In terms of sectors, artificial intelligence has emerged as the dominant theme in startup investing. AI startups accounted for 32% of all seed-stage investments in 2024, reflecting both investor enthusiasm and the transformative potential of this technology. Biotech and fintech continue to attract significant capital as well, with each sector representing unique growth opportunities. For new investors venturing into startup territory, it's critical to understand that this isn't a get-rich-quick scheme. The typical timeline from investment to potential exit, when you might see returns, can be 5 to 10 years. This long holding period underscores why startup investments should represent just a portion of your overall portfolio. They're illiquid for extended periods. When evaluating potential startup investments, look beyond just the business idea to assess the quality of the founding team, the size of the potential market, the competitive landscape, and whether the company has demonstrated early traction. These factors significantly impact the probability of success. It's also worth considering the difference between equity and convertible notes, two common investment structures in early-stage deals. Equity gives you direct ownership in the company from day one, while convertible notes are essentially loans that convert to equity at a later funding round, often with beneficial terms for early investors. Remember that proper due diligence becomes even more important when investing in startups. While platforms provide basic information, don't skip your own research. Check founders' backgrounds, understand the competitive landscape, and realistically assess market potential. The information asymmetry in private markets makes this research step crucial for success. Another point to consider, unlike real estate or fine art, startup investments typically don't generate cash flow while you hold them. Your returns come almost exclusively when the company either goes public or gets acquired. Events that are relatively rare and completely outside your control as a minority investor. Despite these challenges, the democratization of startup investing represents an extraordinary opportunity. For the first time in history, regular investors can build diversified portfolios of early-stage companies with relatively modest sums of money. This access to an asset class previously reserved for the ultra-wealthy could be a game-changer for those willing to embrace the higher risk profile for potentially which alternative is right returns. Option 3 stands out as the most fitting inspiration for our next section, but I'll craft something even better to discuss how these alternative investments compare. With all these investment options on the table, you're probably wondering which one deserves a spot in your portfolio. Here's the thing about alternative investments that most financial advisors won't tell you. The best choice isn't about maximum returns. It's about knowing how much volatility you can handle without panic selling at the worst possible moment. Let's break down these 5 alternatives side by side. One of the most striking differences between these investment classes is the entry point. While platforms like Fundrise have democratized real estate investing with minimums as low as $10, entering the luxury watch market typically requires at least $10,000 for anything with genuine investment potential. Fine art sits somewhere in the middle, with platforms like Masterworks allowing entry for around $1,000, making the previously exclusive world of blue-chip artwork more accessible. But minimum investment is just one piece of the puzzle. When it comes to liquidity, how quickly you can convert your investment back to cash, these alternatives couldn't be more different. This is crucial because even the most promising investment can become a financial headache if you suddenly need cash but can't sell. Fine art and luxury watches rank among the least liquid investments on our list. While they might maintain or even increase in value during economic downturns, finding the right buyer at the right price often takes time. You wouldn't sell a Patek Philippe watch in a day the same way you'd sell a stock with the click of a button. Fractional real estate offers a middle ground through platforms with redemption programs that provide quarterly liquidity options, though these can be suspended during market stress. A detail buried in the fine print that many investors overlook. What about risk? This is where your personal comfort level really matters. Fine art and luxury watches have historically demonstrated lower volatility compared to other alternatives. They're the steady tortoises in this race, not sprinting ahead dramatically, but rarely falling far behind either. During both the 2008 financial crisis and the 2020 COVID market crash, luxury watches showed remarkable resilience, recovering faster than traditional equity markets. The art market followed a similar pattern, with minimal declines before quickly rebounding. In stark contrast, the sneaker market and tech startups represent the hares, capable of explosive growth, but equally susceptible to dramatic downturns. Looking at recent data, sneaker market values have been particularly volatile, with secondary market prices dropping by 25% in 2023 alone. And while tech startups offer the tantalizing potential for returns that could change your life overnight, they come with substantial risk of total loss. Fractional real estate investments position themselves as the middle ground option. They don't offer the potential 1000x returns of a successful startup investment, but they also don't carry the same risk of complete failure. Their performance tends to be more predictable, combining elements of income and appreciation, though they're not immune to broader market downturns, as we saw in 2023. Now let's talk about correlation, a fancy way of saying, do these investments zig when the stock market zags? This is where fine art and luxury watches really shine. The data shows these asset classes often have a negative correlation with the stock market, making them effective portfolio diversifiers. When stocks are tanking during a recession, luxury watches and fine art have historically maintained or even increased their value. This negative correlation is the secret sauce that can make alternative investments so powerful. During the 2008 financial crisis, when the S&P 500 was in freefall, certain luxury watch models not only held steady, but actually appreciated. The same pattern emerged during the COVID crash. While traditional markets plummeted, these tangible assets demonstrated remarkable stability. Think about what this means for your overall portfolio. When your stocks are down 30%, having investments that remain stable or even gain value can provide both financial and psychological benefits. This is why wealthy investors and institutional funds have long included alternatives in their portfolios, not just for the returns, but for protection against market volatility. But how much of your portfolio should you allocate to alternatives? Expert recommendations suggest that a balanced portfolio should dedicate about 10 to 20% to alternative investments. And within that allocation, diversification across multiple asset classes is crucial. You wouldn't put your entire alternative allocation into a single startup or watch. That would defeat the diversification benefit. Let's visualize this with a hypothetical $100,000 portfolio. Following the expert recommendation, you might allocate $15,000, 15%, to alternatives. That $15,000 could be spread across multiple alternative assets. Perhaps $5,000 in fractional real estate, $5,000 in fine art shares, $3,000 in a luxury watch, and $2,000 spread across several startup investments. This approach gives you exposure to the potential upside of alternatives while limiting your downside risk. If one alternative investment underperforms, you're not overly exposed. Meanwhile, you maintain the bulk of your portfolio in traditional investments that offer greater liquidity for everyday financial needs. Your risk tolerance should ultimately guide these allocation decisions. If the thought of losing money keeps you up at night, you might lean toward fine art and luxury watches with their lower volatility profiles. If you're comfortable with greater risk in exchange for potentially life-changing returns, startup investing might deserve a larger slice of your alternative allocation. Age is another factor to consider. Younger investors with longer time horizons can typically afford to take more risks, allocating more to high-risk, high-reward alternatives like startups. As you approach retirement, shifting toward more stable alternatives like fine art or fractional real estate might make more sense. Remember that each alternative investment brings its own unique risks beyond just market volatility. Fine art and luxury watches face authentication and forgery risks. Sneakers can deteriorate if not properly stored. Tech startups can fail due to poor execution or changing market conditions. Fractional real estate investments can suffer from poor property management or regional economic downturns. The key is finding the right mix that aligns with your financial goals, risk tolerance, and personal interests. There's no one-size-fits-all approach to alternative investing. The wealthy investor with multiple homes might allocate differently than the young professional just starting to build wealth. Getting started, platforms, fees, and first steps. While wealthy investors have teams of advisors guiding their alternative investments, most of us are left figuring out the nuts and bolts on our own. Between complex account setups, verification processes, and fee structures that can eat into your returns, the entry barriers seem designed to keep average investors out. Let's cut through this complexity and map out exactly how to get started with each of these alternative investment options. The excitement of potentially higher returns can quickly fade when faced with the practical realities of setting up accounts and understanding fee structures. But don't worry, I've broken down the process for each platform to make your entry into alternative investing as smooth as possible. Let's start with Masterworks, the platform that lets you invest in blue-chip art. Setting up an account is surprisingly straightforward. You'll need to complete an online registration form, verify your identity, and link a bank account for funding, a process that typically takes less than 10 minutes. But here's what you really need to know about the costs. Masterworks charges a 1.5% annual management fee on your investment, which is similar to many actively managed mutual funds. However, they also take a hefty 20% performance fee on any profits when the artwork sells. That's a significant bite out of your returns that many new investors overlook. The minimum investment on Masterworks starts at $10,000, which is considerably higher than some other alternatives we've discussed. This high entry point reflects the premium nature of the asset class, but may put it out of reach for many beginning investors. For your first investment, Masterworks recommends focusing on established artists with proven track records rather than emerging talents that carry higher risk. Moving on to StockX, the sneaker marketplace operates on a different fee model entirely. Creating an account is simple. Just sign up online, verify your email, and provide payment information. But the fee structure is where it gets interesting. StockX charges sellers a fee ranging from 9% to 15% based on their sales volume. Plus, buyers pay a 3% processing fee on each purchase. Unlike traditional investments, there's no annual fee. They make their money on transactions instead. If you're looking to sell on StockX, you'll need to upload photos and provide details about your sneakers. The platform has implemented robust measures to combat counterfeiting, including a verification process for all items sold. For beginners, StockX recommends focusing on limited edition sneakers that have shown historical appreciation rather than trying to predict the next big thing. Fundrise offers perhaps the most accessible entry point into alternative investments with a minimum investment of just $10. Account setup is incredibly user-friendly. Sign up online, choose an investment plan, and complete a questionnaire to assess your risk tolerance. The entire process can be completed in under 15 minutes. Fundrise charges a total annual fee of 1%, which includes a 0.85% asset management fee and a 0.15% advisory fee. While this is higher than many index funds, it's significantly lower than traditional real estate investment fees. One aspect of Fundrise that new investors should understand is their redemption program. While they allow investors to sell shares quarterly, early redemptions may incur a penalty. This reflects the relatively illiquid nature of real estate investments. For beginners, Fundrise suggests diversifying across different real estate projects rather than concentrating in a single property type or location. If startup investing intrigues you, AngelList provides access with a significantly lower barrier to entry than traditional venture capital. You'll need to create an account, verify your identity, and in some cases, prove your accreditation status for certain investment opportunities. The account setup process typically takes about 10 to 15 minutes. AngelList's fee structure differs from other platforms we've discussed. They don't charge management fees, but instead take a 5% carry-on profits from successful investments. This aligns their incentives with yours. They only make money when you do. The minimum investment is just $1,000, making it one of the more accessible ways to participate in startup funding. Remember though, only about 2.5% of seed-stage startups on AngelList achieve unicorn status, so the risks are significant. When beginning with startup investments, AngelList suggests diversifying across multiple early-stage companies rather than betting heavily on a single startup. This approach acknowledges the high failure rate, but positions you to benefit from potential outsized returns from the few successes in your portfolio. A critical aspect of alternative investing that's often overlooked is the tax implications. Profits from sales are typically subject to capital gains tax, which varies based on how long you've held the asset and your tax jurisdiction. Each alternative investment carries unique tax considerations you should understand before committing your money. For example, art and sneaker sales are generally subject to capital gains tax when sold at a profit. Real estate investments through platforms like Fundrise may offer tax advantages like depreciation, while startup investments through AngelList might qualify for special tax treatment under certain conditions. Another important consideration is time commitment. Fundrise investments typically require a long-term horizon of around 5 years for optimal results. Masterworks allows for potential liquidity through secondary sales after a holding period, but investors should be prepared for the relative illiquidity associated with these investments compared to stocks or bonds. For most beginners, I recommend starting with just 5% of your portfolio in alternatives, then gradually increasing as you become more comfortable with how they work. This cautious approach lets you test the waters without overexposing yourself to risk. Even this modest allocation can significantly boost your overall returns while adding valuable diversification to your portfolio. Let me give you a concrete example. If you have a $10,000 portfolio, you might start by putting $500 into alternatives. You could split this between $250 in Fundrise for real estate exposure and $250 in a startup investment through AngelList. As your confidence grows and you see how these investments perform, you can gradually increase your allocation and expand into other alternative asset classes. Hidden risks and common mistakes to avoid. That gradual approach to alternative investing is wise. But even a cautious 5% allocation won't protect you from the invisible traps that have bankrupted countless first-time investors. The most dangerous threats to your portfolio aren't market downturns, but the mistakes that no one warns you about until it's too late. Let me pull back the curtain on what's really happening in these markets. While you're carefully researching returns and minimum investments, there's a shadow side to alternative assets that most investing videos conveniently skip over. These pitfalls aren't just theoretical. They're actively draining money from unsuspecting investors right now. Take the sneaker market, where authentication issues have reached crisis levels. The counterfeits aren't just good anymore. They're nearly indistinguishable from the real thing. Last year alone, StockX had to reject over 325,000 products that failed their verification process. Imagine buying what you think is a valuable collector's item only to discover it's worthless when you try to sell it. And we're not talking about obvious fakes here. These are sophisticated counterfeits that can fool even experienced collectors. But authenticity issues are just the beginning. The sneaker market that looked so promising has recently hit a major speed bump. eBay's sneaker sales plunged by more than 30% in just 1 year, with average prices dropping 16%. That hot investment that everyone said couldn't miss suddenly left thousands of investors holding inventory they can't sell, or can only sell at a significant loss. This pattern repeats across alternative investments. The luxury watch market experienced an even more dramatic correction. Remember all those influencers showing off their watch collections and boasting about investments that only go up? The reality check came hard and fast when the watch chart's overall market index crashed approximately 40% from its peak in March 2022. Investors who bought at the top, convinced they were making a smart move, suddenly found themselves underwater by tens of thousands of dollars. One of the biggest traps I see new investors fall into is the liquidity trap. Unlike stocks that you can sell with a click, many alternative investments can lock up your money when you need it most. Picture this scenario. You've invested in a fractional real estate platform. Everything's going great, then suddenly you need cash for an emergency. You go to withdraw your money only to discover there's a redemption queue, and it could be months before you can access your funds. This isn't hypothetical. During market downturns, many platforms activate waiting periods or even completely suspend redemptions. Your money is technically still yours, but you can't touch it. This is particularly common with real estate platforms, where the underlying assets can't be liquidated quickly. The prospectus might mention these policies in the fine print, but most investors don't read or understand the implications until it's too late. Then there's the emotional investing trap, which hits alternative investors especially hard. FOMO, fear of missing out, drives people to make terrible decisions when they see others profiting. You hear about a friend who made a killing on limited edition sneakers, so you rush to buy the next hot release without proper research. When market demand shifts, you're left holding items nobody wants. I've seen investors empty their savings accounts to chase trends in collectibles, convinced they'd found a shortcut to wealth. The psychology behind this is powerful. When you see others succeeding, your brain overrides rational thinking. The sneaker market is particularly prone to this emotional cycle, creating boom and bust patterns that leave latecomers holding the bag. Authentication issues don't just plague sneakers. In the luxury watch market, fraud is rampant and growing more sophisticated by the day. Buyers can easily be misled by inflated listings that misrepresent a watch's true value. What looks like a good deal might actually be priced well above market value. And unless you've spent years studying the market, these tricks are hard to spot. Another mistake that cripples returns is overconcentration. I've seen investors put 50% of their alternative allocation into a single asset class, or worse, a single item. When that market sector crashes, and eventually some will, their entire alternative strategy collapses. This is particularly dangerous with volatile assets like collectibles and startups, where the failure rate is naturally high. The platform terms themselves can be a hidden minefield. Each alternative investment platform has its own rules regarding fees, liquidity, and redemption policies. Some charge performance fees that eat significantly into your returns. Others have complex redemption structures that limit when and how much you can withdraw. Many investors skip the terms of service, focusing only on projected returns, and end up blindsided by restrictions they never knew existed. So what's the solution? I recommend implementing what investment advisors call the Rule of 5. Diversifying across at least 5 different investments within each alternative category you enter. This approach dramatically reduces your risk exposure to any single asset. If you're investing in sneakers, don't put all your money into one hyped release. Spread it across multiple styles, brands, and price points. The same principle applies to every alternative asset class. For startups, invest smaller amounts across multiple companies instead of betting big on what you think is the next unicorn. With watches, consider a mix of brands and models rather than concentrating on a single sure thing. This strategy isn't just about reducing risk. It's about giving yourself multiple paths to success. When you diversify properly, you don't need every investment to be a winner. Even with a few underperformers, building your overall returns can remain strong if you spread your bets wisely. Spreading your bets within alternative investments is essential, but determining the right percentage for your total portfolio might be the most pivotal decision in your wealth-building strategy. Would you believe that portfolios with a carefully calibrated allocation to alternatives have historically outperformed traditional investment approaches by up to 3% annually over the past decade? That's the difference between retiring on time and retiring 5 years early. When financial advisors talk about the perfect recipe for alternative investments, most converge around a specific target, 15%. This isn't some arbitrary number pulled from thin air. It's backed by performance data from sophisticated investors who've tested various allocations over decades. This sweet spot provides enough exposure to boost returns without introducing excessive risk. But here's where most investors go wrong. They get excited about the potential returns and dump too much money into alternatives all at once. I've seen people go from 0% to 20% overnight after watching a single TikTok about somebody flipping watches for a 200% profit. That's like trying to run a marathon without training. You're setting yourself up for pain. Instead, consider what financial experts actually recommend, a gradual approach. Start with just 5% of your portfolio and increase by 1 to 2% every few months as you learn the ropes. This methodical strategy gives you time to understand how these assets behave through different market conditions before committing more capital. But how should you divide that 15% across different alternative assets? This is where personal risk tolerance becomes crucial. If you're more conservative, consider allocating 6% to fractional real estate, 5% to fine art, 3% to luxury watches, and just 1% to startup investments. The more risk-averse you are, the more you should weight toward alternatives with lower volatility and more predictable returns. For those with higher risk tolerance, flip the script. Dedicate 6% to startup investments, 4% to sneakers, 3% to real estate, and 2% to art. This approach maximizes your exposure to high-growth potential while keeping your overall alternative allocation at that magic 15% number. What makes this approach so powerful isn't just the initial allocation. It's how you maintain it over time. When certain alternatives dramatically outperform others, which happens frequently, your carefully planned percentages will drift. This is where rebalancing becomes essential. Rebalancing doesn't mean selling winners and buying losers mindlessly. It means adjusting your portfolio to maintain your target allocation, especially after significant market movements. If your startup investments double in value while your real estate holdings remain flat, suddenly startups might represent 10% of your portfolio instead of the intended 5%. In this case, you might redirect new investment capital toward real estate to bring the percentages back in line, or sell a portion of your startup holdings if they've truly taken off. The timing of rebalancing matters too. While traditional investments might be rebalanced quarterly or annually, alternatives often require a different approach. Many financial experts suggest reviewing your alternative allocations semi-annually rather than more frequently, as these investments tend to be less liquid and may incur higher transaction costs when buying or selling. Here's where technology comes to the rescue. Tracking alternative investments alongside traditional assets used to be a nightmare, requiring spreadsheets and manual updates. Today, platforms like Fundrise provide comprehensive dashboards that integrate with your overall portfolio management. Apps like Kai's offer similar tools for high-net-worth investors to visualize their entire investment landscape in one place. The psychological aspect of alternative investing might be the most underrated challenge. These investments can experience wild swings in value, and their illiquid nature means you can't always cash out when fear strikes. This creates a perfect storm for emotional decision-making, precisely when you need to stay calm and stick to your strategy. Research shows that psychological factors like fear and anxiety can actually amplify volatility in alternative markets. When investors panic and try to sell a liquid asset simultaneously, prices can drop far below intrinsic value. Conversely, when excitement builds around certain alternatives, prices can soar to unsustainable levels. To combat these psychological challenges, establish clear investment rules before you start. Decide in advance what would constitute a reason to sell, perhaps a fundamental change in the market or a specific return threshold, rather than reacting to short-term price movements. Document these rules and review them whenever you feel the urge to make a hasty decision. Many successful alternative investors also recommend a cooling-off period. If you're considering selling an alternative investment because of market conditions, force yourself to wait 72 hours before executing the trade. This pause often provides enough time for emotional reactions to subside, allowing for more rational decision-making. The evidence supporting this balanced 15% approach is compelling. A traditional 60-40 portfolio, 60% stocks, 40% bonds, has historically delivered solid returns, but those adding a 15% alternative component have seen their performance improve significantly. These enhanced portfolios have demonstrated particular resilience during inflationary periods and market downturns. What's most surprising is how this relatively modest 15% allocation can move the needle so dramatically on overall returns. That's because alternatives don't just add a different return profile. They fundamentally alter how your portfolio responds to market conditions. When stocks and bonds both struggle, as they often do during inflationary periods, certain alternatives can shine brightest. Some investors might wonder if 15% is enough given the impressive returns alternatives can generate. The answer lies in understanding the risk-adjusted return, not just the absolute performance. Going beyond 15% might increase your potential upside, but it also exponentially increases your risk profile, especially if you haven't mastered the unique challenges of alternative investing. Remember, the goal isn't to maximize returns at all costs. It's to optimize your risk-adjusted returns while maintaining the liquidity and stability you need to meet your financial goals. For most investors, that sweet spot lands right around 15%. The future of alternative investing, where smart money is heading. While that 15% sweet spot works perfectly today, what if I told you the ultra-wealthy are quietly shifting much more of their money into alternative assets most people haven't even heard of yet? University endowments and pension funds aren't just dipping their toes in alternatives. They're diving headfirst, with many targeting 20% or more of their portfolios in these unconventional investments. This shift isn't just about chasing higher returns. It's about positioning for the future economy. While you're just getting comfortable with the alternatives we've discussed, the smartest money in the world is already looking around the corner at what's next. Let's peek behind the curtain at where alternatives are heading in the next decade. Music royalties are emerging as one of the hottest new asset classes. Think about it. Every time a song plays on Spotify, Apple Music, or gets used in a TV commercial, it generates income. Now platforms are making it possible to own slices of song catalogs from major artists, letting you earn a tiny payment every time their songs are streamed or licensed. Carbon credits represent another frontier in alternative investing. As governments worldwide impose stricter emission standards, companies need to offset their carbon footprint by purchasing credits. This growing market allows investors to essentially bet on the transition to a greener economy, with potential for significant returns as climate regulations tighten globally. What makes these new categories so exciting is how they combine financial opportunity with real-world impact. Investing in music royalties supports artists, while carbon credit investing contributes to environmental goals. This alignment of profit and purpose is particularly appealing to younger investors who want their money to do more than just grow. But how will you know these investments are legitimate? That's where blockchain technology enters the picture. Beyond cryptocurrencies, blockchain is revolutionizing how we verify ownership of alternative assets. For art, collectibles, and even fractionalized real estate, blockchain provides an immutable record of authenticity and provenance. Imagine buying a piece of digital art or a fraction of a physical painting and having absolute certainty it's authentic. Blockchain is making this possible by creating tamper-proof records that follow assets throughout their lifetime. This technology is solving one of the biggest problems in alternative investing: trust. For sneaker collectors, blockchain authentication could eliminate the risk of counterfeits. For watch investors, it could create an unbroken chain of ownership history. And for startup investors, it could transform how equity is distributed and tracked. Speaking of startups, the venture capital landscape is undergoing a massive shift right now. While Silicon Valley has dominated for decades, the data shows emerging tech hubs are actually outperforming the traditional powerhouse. Startups in these areas are achieving an aggregate internal rate of return of 19.4% annually, compared to Silicon Valley's 17.5%, a pattern smart money has already noticed. This geographic diversification speaks to a broader trend. Opportunity is spreading beyond traditional centers of wealth. Just as alternative investments are democratizing access to asset classes once reserved for the elite, innovation is decentralizing across the global map. The AI revolution is another force reshaping the alternative investment landscape. It's not just about investing in AI startups, though that's certainly happening, with 32% of all seed-stage investments in 2024 carrying an AI label. It's also about how AI is transforming the analysis and management of alternative assets themselves. Platforms are increasingly using artificial intelligence to identify undervalued art, predict which sneaker releases will appreciate, and even analyze startup pitch decks for success factors. This technology is giving everyday investors access to the kind of analytical firepower once available only to institutional players. So what's driving this massive shift toward alternatives? Financial experts point to several factors. Persistent inflation concerns are pushing investors toward hard assets that traditionally hold value during inflationary periods. Market volatility has highlighted the need for true diversification beyond stocks and bonds. And the search for higher returns in a world of compressed yields makes alternatives increasingly attractive. The institutional money knows this. That's why university endowments and pension funds are dramatically increasing their alternative allocations. These sophisticated investors with multi-decade time horizons aren't making these moves on a whim. They're positioning for fundamental changes in the global economy. As alternatives become more mainstream, the platforms connecting investors with opportunities are evolving too. Companies like Kai's are expanding access to alternative assets for financial advisors and their clients, continuing the democratization trend we've seen throughout this video. But there's a catch to all this innovation. Early movers get the advantage. By the time an alternative investment becomes widely accessible and understood, much of its excess return potential has typically disappeared. The sweet spot is identifying trends just as they're becoming accessible, but before they go mainstream. This is precisely why understanding these emerging categories now, even if you're not ready to invest, is so valuable. You're developing pattern recognition that will help you spot the next opportunity before the crowd arrives. Economic factors will naturally impact different alternative assets in various ways. Rising interest rates typically pressure startup valuations and real estate prices, but may have limited effect on assets like fine art or collectibles. Understanding these relationships helps you position your alternative allocation to thrive in different economic environments. What does all this mean for your portfolio? Well, while that 15% allocation to alternatives represents a prudent approach today, don't be surprised if that recommended percentage creeps higher over the next decade. The global alternative investment market is projected to reach an astonishing $22 trillion by 2025, representing 15% of global assets under management. This isn't just a temporary trend. It's a fundamental reshaping of how wealth is built and preserved. The walls between institutional and retail investing are crumbling, creating unprecedented opportunities for everyday investors willing to expand their horizons. We've explored a whole world of investment opportunities beyond what your financial advisor probably shows you. But here's the exciting part. Alternative investments aren't just a playground for the ultra-wealthy anymore. With $22 trillion now flowing through alternative investments, representing about 15% of global assets, this space has officially gone mainstream. It's particularly telling that 73% of young investors between 21 to 43 are diversifying into alternatives like art. They recognize what industry experts like Chris Harvey highlight. Success in 2025 means balancing LP liquidity needs with long-term value creation. The power of these investments isn't just in their potential returns. It's about taking control of your financial destiny. Start small, stay informed, and build gradually. Whether you explore art through masterworks, real estate via Fundrise, or startups on Angel List, you now have the knowledge to